You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast.
Last week it was all about major signals from central banks. We saw an anticipated rate cut from the Reserve Bank of New Zealand, but also a very firm stance from the European Central Bank.
And that guidance seems to have completely recalibrated interest rate expectations around the world.
Oh, absolutely, especially with all the speculation heating up over who will be the next to lead the Federal Reserve.
Right, so that policy context is now feeding directly into what looks like a pivotal big data week.
Yeah, we have critical inflation numbers and key output surveys coming from the United States and the Euro area.
So today we're going to analyze what that split vote at the Reserve Bank of New Zealand really implies, and how the debate over the next Federal Reserve chair is already, believe it or not, steepening the Treasury curve.
And we'll really focus in on those essential data releases, from the delayed United States personal consumption expenditures report all the way to the Euro area inflation print and what it all means.
Let's unpack it.
So starting with the Reserve Bank of New Zealand.
Yeah, that seems like the clearest action from last week. They gave us that 25 basis point reduction everyone was expecting.
Right, dropping their official cash rate down to 2.25%. But, the cut itself wasn't really the interesting part.
No, the reasoning behind it gets at this global tension we're seeing everywhere.
Exactly. I mean, they're dealing with annual inflation that's still up at 3%.
Which is high.
It is. And yet they still cut because they're making this big bet on spare capacity in the economy. They think that's what will pull inflation back down to their 2% target.
That feels like a very long-term bet, especially
Yeah.
when you look at the minutes and see the decision wasn't even unanimous.
Not at all. It was a 5-1 vote.
And that one dissenter, their argument was that, well, a lot of easing had already been done.
Right. Precisely. They basically said another cut looks a little like panic, that it overstates the excess capacity problem. But the other 5, the majority, felt they had to act on the capacity issues they see right now. It's a classic policy dilemma.
Yeah, it shows them just trying to navigate this really uncomfortable gap between today's inflation and, well, a hopeful forecast for mid-2026.
And Governor Hawksby had to come out pretty quickly to manage expectations, didn't he?
He did. He said the bar for more cuts is now, quite high. So they cut, but then immediately signaled that might be it for a while.
Okay, so now let's contrast that with the European Central Bank.
A much steadier hand over there.
Much steadier. The minutes confirmed no real change in their story. All the members agreed they just need more information before they think about adjusting rates.
What I found really interesting was the framing, the sort of psychological aspect. They're deliberately placing their policy weight on the nearer-term outlook.
Right. It's like they're saying, look, decisions we make today have, less and less influence on inflation way out in 2028.
So they're sticking to managing what's right in front of them.
It's a deliberate limiting of their scope. And it really reinforces the market consensus, which is that a deposit rate of 2% is probably the terminal rate, the ceiling for this cycle.
But they absolutely need this week's data to back that up, to justify staying on pause.
They do.
Okay, let's go across the Atlantic, because all this careful policy talk is being, frankly, overshadowed by politics in the U.S.
The succession question at the Federal Reserve.
Exactly. Who's going to succeed Chair Jerome Powell? The president is expected to name someone before Christmas, which is way ahead of Powell's term ending in May of 2026.
And this is creating some serious tension in the markets. Treasury Secretary Bessent is interviewing candidates, and the shortlist is pretty interesting.
You have Hassett, Warsh, Ryder, and then current governors Waller and Bowman.
And the reports that Hassett was the front runner that caused an immediate reaction.
A really specific reaction, too. The Treasury curve steepened. For anyone who doesn't track bond mechanics daily, what does that actually mean? Why did the Hassett news trigger that specifically?
It's so crucial to get this. So think of the yield curve in 2 parts. You have the front-end short-term bonds. That reflects what the Federal Reserve is expected to do, say, in the next 6 months.
Okay, immediate action.
And then you have the long-end 10-year, 30-year bonds, which reflects, let's call it, long-term economic trust and inflation fears.
So short-term rates are about policy, long-term rates are about faith in the system.
You've got it. So when the curve steepens, it means the short-term yields might be falling because someone like Hassett is seen as dovish, favoring lower rates. But at the same time, the long-term yields surge higher.
Wait, that seems contradictory. If everyone expects lower rates, why would long-term borrowing costs go up?
It's the market demanding what's called a higher term premium. It's basically an insurance policy against long-term inflation risk.
Oh, okay.
If the market perceives that a new Federal Reserve chair might prioritize political goals over, strict monetary independence, it starts to worry.
They worry the Fed won't fight inflation aggressively down the line. It loses credibility.
Precisely. So long-term bondholders demand a higher interest rate to compensate them for taking on that risk, that lack of trust.
So that's how political risk turns into a real financial cost. The market is pricing in easy money now, but much higher risk later on.
And it's worth noting that appointments like Waller or Bowman, who are already on the board, would raise far fewer of these kinds of independence concerns. It would be seen as continuity.
And that entire backdrop creates, I guess, a perfect bridge to this big data week. All this speculation will be tested by the actual numbers.
Starting with the Institute for Supply Management, the ISM, surveys in the U.S.
Where we're seeing that classic frustrating split between goods and services again.
We are. The manufacturing side is still flashing warning signs. You've got slowing new orders, softer export demand, and a record jump in unsold inventories.
Not a great picture for the goods economy.
No. But then you look at services, which is the bulk of the economy, and it's a different story. Stronger output, faster rising input costs.
Which they're linking to tariffs and wages, right?
Yes, directly. Both of these surveys are going to be critical inputs for the December Federal Open Market Committee meeting. And those expectations are really hanging on the delayed inflation report.
The personal consumption expenditures report, yeah.
Yeah.
The one delayed by the government shutdown.
So analysts are forecasting what happened 2 months ago. The consensus is for the core deflator, the Fed's favorite gauge, to rise only about 0.22% month over month.
And if that holds, it would keep the annual rate around 2.9%.
Right. And those kinds of subdued numbers are exactly what's underpinning the market's conviction. There's about an 85% probability priced in for a 25 basis point rate cut in December.
So the data this week really needs to cooperate for that to hold.
It absolutely does.
Now, over in Europe, the European Central Bank is just as eager for its own data. They're waiting on the flash harmonized index of consumer prices.
And this is a tricky one for them. They've been very clear that they need to see non-energy price growth slow down. The last reading was sticky.
And this next one is complicated by what's happening in individual countries.
Very complicated. You've got early data suggesting France is cooling off, but Spain seems to be heating up. What the European Central Bank needs is a clear, convincing downtrend across the board to stick with their wait-and-see plan.
Okay, let's widen out a bit more. We also have Australia's third quarter GDP report coming.
And the headline growth is expected to have slowed down. But the number to watch, really, is output per capita.
The per capita recession.
Exactly. It's expected to stay negative, which just means population growth is still outpacing economic growth. It keeps the pressure squarely on households, even if the Reserve Bank of Australia is expected to hold rates.
And what about Switzerland? They've got their November inflation data. The last print was tiny, just 0.1% year over year.
Yeah, that tiny number immediately got people talking about a return to negative interest rates, which, sounds dramatic, but they have been there before.
But officials pushed back on that pretty hard, didn't they?
They did. They stressed that the bar for going back to negative rates is much higher than for just a standard rate cut.
So what's their primary tool then?
They're making it clear that it's foreign exchange intervention. Managing the strength of the Swiss franc to control import prices, that's a key policy difference that markets can sometimes forget.
And we wrap up in Canada with their labor market report. The last one was pretty strong.
It was, but the Bank of Canada has basically said their policy is appropriate as is. They're pointing to damage from global trade conflicts and saying, look, there's only so much monetary policy can do. They're unlikely to ease unless the economy really weakens.
Okay, so let's try to tie this all together.
Yeah.
We have the Reserve Bank of New Zealand cutting cautiously, the European Central Bank holding firm, and the U.S. market completely fixated on political risk. What stands out most is this split personality in the U.S. market.
That's a great way to put it. It's the highest leverage point right now. The front end of the Treasury curve is screaming that the data justifies a rate cut in December.
That 85% probability.
Right, based on cooling inflation. But the long end of the curve is demanding a higher premium because of political uncertainty over who will lead the Federal Reserve. It's short-term optimism clashing directly with long-term institutional doubt.
Which really brings up a fascinating question for you, the listener, to think about. If the long-term cost of borrowing goes up because the market loses trust in the Federal Reserve's independence, does that loss of credibility fundamentally undermine the entire goal of getting those lower short-term rates in the first place, no matter what this week's data says.
It's definitely something to mull over as you watch that personal consumption expenditures report land.
That was an essential look at the shifting global rate environment and what we need to watch out for this pivotal data week.
We appreciate you tuning in to the Financial Source podcast. Join us again next time for more critical analysis.